All right. So, mhm, all right. All right. So, E represents expenses. Expense accounts are very easy to see. All right. You see rent account, utilities account, water, telephone bills. Expense accounts are easy to see. A represents assets. Colleagues, what are assets? What is an asset according to accounts? Sure, nobody knows. Well, how many here? Somebody should know at least what an asset is, colleagues. Okay, assets, these are the things that we own as a business. And assets can be divided into current assets, things that we can own for not more than a year, all right? These assets will get used up within a year, all right? And then you also have your non-current. What was that? Non-current assets. Colleagues, are you able to get getting fee? Are you able to get me clear? Non-current assets, these are assets you can own for more than a year. Okay. Current assets will get used up within a year. Non-current assets, you can own them for more than a year. Do we know any examples of current assets? Madam Yvonne, could you mute your mic? All right, yes. So when I was kicked out, I was explaining assets, things that we own. They can be divided into current assets and non-current assets. Current assets, you can only own them for a year or less. You can't own them for more than a year. But non-current assets, you can own them for more than a year. So the question I posed, do we know any examples of current assets? Wow, no, none of you took accounts before? Okay. Current assets, you've got inventory, the goods that you sell. You've got your receivables or debtors. These are people who owe you money. You've got cash in hand. You've got cash at bank. So we just say here bank. And you've also got prepayments. Whenever you make a payment in advance on expense, it's regarded as a prepayment and treated as a current asset. So these are some of the examples of the current assets you're going to come across. All right. The non-current assets, we have buildings, we have land, we've got motor vehicles, fixtures and fittings. Those are some examples of the non-current assets. Okay. So I forgot to mention one thing. These accounts, expenses, assets, drawings, liabilities, income or revenue and capital. These are the major accounts you're going to be dealing with in this course. Okay. These 6 accounts. There are more, but these ones you're going to be dealing with them a lot. Okay. Then this D here stands for drawings. Okay. Anytime you take out money from the business, you as the owner, for your personal use. Okay, you can take out money, even some of the inventory that you use for selling. If you take some of that for your personal use, that is drawings. Okay. L here represents liabilities. What we owe. Okay. And we've got current liabilities, which you have to pay within a year. These have to be paid within a year. Then you've also got non-current liabilities, which you can pay even after a year. So amongst the non-current liabilities, you've got any long-term loans, all right, which you have to pay after 5 years, 2 years, 3 years. Any mortgages, those would fall under non-current liabilities. Under current liabilities, you've got your overdrafts, bank overdrafts. You've got your creditors, also called your payables. So here in university, will be using the term payables more than creditors. Creditors is usually used for grade 12 and below. Here to be payables. All right, these are just few of them. I'll also send you notes on all the accounts, which is listing all the types of assets, all the types of liabilities, and everything. Yes. So that's for the liabilities. They're also divided into current and non-current. Then here, this I represents income or revenue. Then C represents capital. Colleagues, what is capital? At least someone should know what capital is. What is capital? We use this word very often. Yes, yes, yes. Money and any other form of someone else before I chip in. Yes, go ahead. Okay, yes, money and resources put into the business. All right. These resources can also be machinery, even a car. If you have your personal car and you say, no, this personal car, I want to put it into my business, that will form part of the capital. So this is resources put into the business by the owner. This includes money, equipment, machinery, okay, any form of resource that can be utilized by your business. Yes. So now this diagram here, okay, as we're going to look at the question that was posted there, we're going to use this diagram when we're recording financial transactions. Okay. Whenever you're recording financial transactions, you have to follow the double entry rules. And double entry rules are summarized in this diagram here. If you incur any expense in a financial transaction, you debit that expense. Okay, if you read the transaction and you say an expense was paid, that expense you're going to debit it. Okay, always just remember that. Anytime just an expense, debit it. If you are acquiring any assets, current, non-current, you are also going to debit. This D here is the debit side here. Okay. If you acquire any assets, you're going to debit. Okay. If there is any drawings in that transaction, you're going to know that you're going to need to debit drawings. The reason why drawings is debited is because drawings reduces capital. Okay, capital increases with credit, drawings reduces capital. So it means if it's reducing capital and capital increases with the credit, it means that it has to be on the debit side. So you're going to hear me use increase or decrease. So any increase in expenses, assets, drawings, you debit. If there are any decreases in expenses, assets, or drawings, then the opposite is true. You're going to have to credit. Okay, colleagues? Any increase in expenses, assets, or drawings, you debit. Any reduction in any of these three accounts, the opposite is true, meaning you're going to have to credit. Then, any increase in liabilities, income, or capital, you are going to credit. And any decreases in any liabilities or income or capital, then the opposite is true. You have to debit. So I'm going to illustrate how we're going to use the same diagram here. Okay. I posted this. This is the question I posted on the group. Okay. We've been told to form a trial balance. Remember, the trial balance is just a check to see that these transactions which you recorded, you did them correctly. If the trial balance balances, then it means these transactions that you did, you recorded them correctly. If the trial balance doesn't balance, it means you made a mistake in one or two or many of these transactions. Okay, so the trial balance is just a check to see if you've recorded your transactions well. So we're going to look through these transactions and we're going to do the recording of these transactions, which are the journal entries. Every time you record a transaction, that's the journal entry we're talking about. And we're going to apply the double entry rules. Okay, with double entry, what it's meaning is if there's a transaction, two accounts on average are affected. Okay, that's what double entry is about. Two accounts are going to get affected. So, as you read a transaction, these are the following rules you need to remember also. For each transaction that you read, number one, you identify the type of transaction. Okay, is it a credit sale? Is it a cash sale? Is it a payment of an expense? Is capital being brought in? Okay, identify the type of transaction. Number two, identify the accounts involved. Are the asset accounts? Are the liability accounts? Are the expense accounts? Is the drawings account involved? Okay, identify the types, the accounts involved. Yeah. Once you've identified the accounts involved, this is where the double entry comes in. Okay, you have to identify which ones are increasing, identify which accounts are increasing, or decreasing. Sometimes two accounts can increase, other times also two accounts can decrease. Other times one account is increasing, another time another account is decreasing. Okay, so this is where the double entry comes into play. Other books they'll tell you, is it debit the credit the giver, debit the receiver? I do not like to use that one. I personally like to use increasing or decreasing because each time a transaction is made, the amount of money in that account is either increasing or it's decreasing. So I prefer to use increasing or decreasing. Right. So these three simple steps, we're going to apply them as we read each transaction. All right. Yes. So we're going to now read the transactions. Okay. So let's go to our document here. Excuse me. I hope we're all able to see clearly what's being written here. All right, so here the question reads: record the following transactions for the month of January for Bwezani family, balance of all the accounts, and then extract the trial balance as at 31st January 2023. All right, so first transaction here started in business with 205,000 cash. Colleagues, first thing we say, what type of transaction is this? Remember, from the wording, just from the wording itself, it will tell you what type of transaction. Okay, you don't have to look anywhere else, but the wording will tell you. Yes, anybody, what type of transaction is this? Yes. Okay, you've moved a step ahead, but yes, capital is involved. Basically, he was starting the business. Basically, that's the transaction that's going to happen. We are starting a business. So after we found out that we're starting a business, now we say, okay, now what accounts are involved? So, sir, you said capital. Yes, capital. The capital account is involved here. What else? Mm-hmm. Which other account? Just look at the wordings, okay? The key is just to look at the wordings, okay? You don't need any prior knowledge. No, the wordings. Yes, colleagues, can anyone tell us, apart from capital, what other account is involved? The cash account, okay? Capital and the cash account are involved, all right? So now we ask, which accounts are increasing and which ones are decreasing? Or are they both increasing and are they both decreasing? Anybody to give it a try? Yeah, the cash account is increasing. What about the capital account? Yes. So we come to this diagram here and we say cash is an asset account. To be specific, it's a current asset. So it is increasing. So we're going to debit cash 205,000 kwacha. Capital is a capital account. It is increasing. So here we're also going to credit capital. So you're going to debit cash 205,000 kwacha. This is how you make a journal entry. Okay. You always start with the debit. Never start with the credit, colleagues. You will lose marks. Okay. So you start with the debit. Debit cash 205,000 kwacha. Credit capital 205,000 kwacha. And you need to open both accounts. Okay. The ledger accounts. You need to open the cash account and you also need to open the capital account. Let me just show you here. So this is the cash ledger or the T account for cash. On the debit side here, have you seen here? You're going to write the other account affected in this transaction. So it was the capital account and you put the amount here. So 205,000 on the debit side of the cash account. And then also on the capital, you also open up a capital account. All right. Put here date. For every ledger account, if it's an exam and you're supposed to open up a ledger account, always remember put the date, details. The details, it's the other account that was involved. So cash was involved. All right. And then you put the amount. So that when I was doing this, I didn't have time to put all of that. But this is the formal way you make the ledger account. All right. You have the three columns: date, details, and amount. Oh, you have a fourth column for folio. That's where you put a balance carried down and balance brought down. But for now, we're just going to keep it as simple as possible. I do not want to confuse you guys so fast. Yes. Any questions, colleagues? So on your papers and pens, just write the journal entry: debit cash 205, credit capital 205. Because this is a very long exercise. Because after the all these journal entries, then you have to do the balancing off of the accounts and you make the trial balance. So to make life easy, let's be going along with the process so that we understand it. Do not worry, all these answers will be sent to you, but just write this down on a piece of paper. Okay, we go to the next transaction. Put 90,000 of cash into the bank account. So you ask yourself, what transaction is going on here? Okay. Sometimes the transaction doesn't have a name, but you just have to understand what is going on here. Colleagues, what's happening here? Remember, just look at the wordings of the question and it will tell you everything. The key is in the wordings, nowhere else in the wordings. So, colleagues, anybody tell us what's happening here? That is that is correct, sir. Although you have skipped. Once you've understood this, yes, you can just go straight to that point. Okay. But since we are many of us here and want to move as a unit, so that's what we're doing step by step. But once you get the hang of it, you won't need to go through these three steps, identify the accounts. No, you just say, okay, you see which accounts and yeah. So here basically we're moving money from the cash account to the bank account. Okay. Yes. So the two accounts involved, cash and bank. All right. Both of these are assets. All right. So we have to see which one is increasing, which one is decreasing. So since money is moving from the cash account, so the cash account is decreasing. So if an asset account is decreasing, you have to credit it. So as our colleagues said, you're going to credit the cash account. The bank account is also an asset account. So since it's receiving that 90,000, means it is increasing. An increase in an asset, you debit. All right. So this is the journal entry. Always start the debit. You debit bank 90,000 kwacha and you credit cash 90,000 kwacha. Any questions, colleagues? Okay. So you have to also now you open up the bank ledger account also. All right. So first we'll just go through all of these journal entries. Then the next step we're going to look at the ledgers and put all these transactions there. Okay. January 3rd, bought goods for cash 100,500. Colleagues, what's happening here? Yes. Yes, someone raised their hand up. Mm-hmm. It's supposed to be purchases account. Every time you buy goods, because here we're assuming this person buys goods for resale. Okay, your business won't just buy goods to be consumed in there. These are for resale. All right. So that's the transaction happening. We're buying goods for resale. The two accounts involved is a purchases account. Purchases account is an expense account. Okay, because when you're buying these goods, that's an expense that you incur. So the two accounts is purchases and the cash account. So which one is in? Are they both increasing? Is one increasing, the other one decreasing? Which one is that one? Wonderful. And cash is an asset account, right? It's an asset account. So if it's decreasing, we credit, right? And and which is increasing? Yes. Purchases is an expense account. So you debit. So the journal entry here, you are going to debit purchases 100,500 kwacha, and you credit cash 100,500 uh, 100,500 kwacha. Yes. Any questions? January 4th, bought goods on credit from Dhaka 8,000, Hambe 9,300, Sombaile 16,000, Lombe 5,100. Okay, what's happening here, colleagues? These are credit purchases that are happening here. This one on the third, this was a cash purchase. All right. Now here, this is a credit purchase. So it means here money hasn't been exchanged. Okay. You've bought goods on Kongol. Okay. So let's start with the dark. All right. So the two accounts involved here, again, it's purchases account. But this time, since cash hasn't been exchanged, we're owing somebody money. So DACA becomes a payable. Okay, we are owing him money. Those are the two accounts involved. So purchases, expense increasing, so you debit purchases 8,000. DACA, at first you never had any people you're owing money. Now you're owing somebody money. So you can say your liabilities have increased. So DACA, you're going to credit him 8,000. Similar with Hambe, you debit purchases 9,300, you credit Hambe 9,300. You debit purchases 16,000, you credit somebody 16,000. You debit purchases again 5,100 and you credit Lombe 5,100. Now, if we wanted, we would have totaled all of these guys up. Now, as we're going to see later on in the transactions, we are going to be retaining some goods. So we need to open individual accounts for these payables. Right? You open the Daka's account, Hambe's account, Sombaire, and Lombe's account. Okay. So throughout, you'll be debiting purchases and you'll be crediting these payables here. Are we okay, colleagues? Mm-hmm. Uh-huh. Please go ahead. Wait. Just you said if you buy on cash, you debit purchases and you credit cash because cash is reducing. So yeah, that's why it's credited. But if you buy these goods on credit, since cash hasn't been exchanged, so you substitute that with the name of the payable. Mm, yes. Okay. Wonderful. So bought stationery on credit from Banda 890. Anybody? What two accounts are involved here? We have stationery expenses and band. All right. So stationery is an expense. You debit it 890. Since we never paid Banda any cash, so he's a payable. So we're going to credit Banda 890 kwacha. Mm-hmm. Yes, is that a question? Okay, if that's not a question, we can move to January 6th. Sold goods on credit to R. Tongo, 1,700. L. Fashan, 2,400. M. Sila, 3,260. And Musonda, 2,000. Yes. No, you're not. You're not disturbing, so don't worry. Yeah. Or you take number four. Okay, here we made the credit purchases. All right. So since we never paid cash, the two accounts that will be involved are the purchases account, which is an expense account, and the people who were owing money, our liabilities. So remember, any expense, when you incur an expense, increase in expenses, you debit. So you debit purchases. Okay. Even for transaction number five, you debit stationary expense. Then, since we haven't paid money, so we are owing people. So that's an increase in our liabilities. So you're going to credit the people's names there. Okay. Payables never just put at payable there. No, you put the actual name of the person. Okay. Never put just payable because as a business you'll be doing a lot of credit purchases. So you need to know how much you're owing certain people. So that's why their names have to be put there. So does that answer your question? Okay. So we're on transaction six. Sold goods on credit. Let's start with Atong. Sold goods on credit to Atong. So colleagues, which accounts are involved? This is here the transaction that's going on is a credit sale. Okay. So cash hasn't been exchanged. Okay. So which accounts will be involved? Mhm. Wonderful, madam. That is actually correct. Sales, which is a revenue account, okay, under here income, okay, income or revenue. So our sales have increased, okay. Each time you make a sale, your sale increases. So you're going to credit sales, okay. It's a revenue account or an income account. Then these people, since cash hasn't, if cash was exchanged, you would have debited cash because your cash is increasing. So you'd have debited cash. Now here, cash hasn't been traded. So you are acquiring a receivable. Somebody who owes you money. All right. Somebody who owes you money is regarded as an asset, a current asset. Okay. So increase in an asset, you debit. Okay, colleague. So you're going to debit Aratonga, Elfashanu, Msila, Musonda. You're going to debit all of these people and you'll be crediting sales in each of the transactions. So you debit Aratonga 1,700, credit sales 1,700. You debit Elfashan 2,400 and you credit sales 2,400. Remember the accruals concept in accounts. Even though you haven't received the money or the revenue, you record. Even expenses, even though you haven't paid for that expense, you still have to record. So you debit MCLA 3260, credit sales 3260. You debit M Sonda 2004 and you credit sales 2004. Okay, question 8, paid rent by check 2,200. So the type of transaction we are paying for rent. Which two accounts are involved, colleagues? Excuse me. Uh-huh. Yes, sir. Wonderful. Yes. So which one is increasing? Which one is decreasing? Yes. And bank is an asset. So a decrease in an asset, you credit. Then rent is an expense. Expenses, remember, when they're incurred, you debit. So you debit rent expense and you credit bank. Yes, so debit rent, credit bank. Wonderful, wonderful. All right. On the 10th, bought fixtures on credit from Chef Limited, 6,100. Okay, what's happening here, colleagues? We're purchasing a non-current asset here, fixtures. Okay, fixtures. Now it's on credit. Okay, we're purchasing this on credit. So the two accounts involved are the fixtures account, which is a asset account, increasing an asset. You debit fixtures. Since we never paid, so we're owing somebody. We're owing Chef Limited. Okay, Chef Limited is now our liability payable. So you're going to credit Shareful Limited. So you debit fixtures account. How much is this? Debit fixtures account 6,100, and you credit Chef Limited 6,100. Okay, I'm supposed to have a class at 22. So let's just do this last transaction. Then we can pause here for today. Paid salaries in cash 7,900. We're paying salaries here. Salaries is an expense. So when you incur an expense, you debit. So you debit the salaries account 6,100. And then cash is an asset. Decrease in an asset, you credit, because assets increase with the debit. So it means they have to decrease with credit. So you're going to credit cash 7,900.